Level 1, $17,400. The form arrives in February. A single sheet of paper. Your employer sent it. A grocery store that scheduled you for 28 hours a week because 29 triggers benefits, and benefits cost them money. The number in box 1 is $17,400. That is what you made. That is what the year cost. You don't own tax software. You go to the library. There is a free program there. VITA, Volunteer Income Tax Assistance. A retired accountant named Gerald helps you at no charge. He is patient. He explains each line. You nod. You understand roughly 40% of what he's saying. That is enough to sign at the bottom. You qualify for the Earned Income Tax Credit, $1,240. The government's acknowledgement that you worked and still barely survived is worth $1,240. You will receive it as a refund in 21 days. You are waiting for $1,240, the way someone waits for an organ. The money goes to 3 places. Back rent, a car repair you've been negotiating with yourself for 2 months, and $200 you promise yourself you'll put somewhere responsible. You put it in a checking account earning 0.01% APY because you don't know what else to do with it. Here is what nobody tells you about this level. The IRS built a free filing system. It is called Free File. It exists for anyone making under $79,000. The major tax software companies agreed to provide it. Then they buried it so deep inside their own websites that most people who qualify never find it. Instead, you pay $89 for software that files the same return Gerald files for free. The IRS has known this for 20 years. The software companies lobbied to keep it this way. The lobbying worked. You are not being helped. You are being managed. The first rule. At $17,400, the government gives you a credit and the market charges you to collect it. Level 2. $35,000. W-2. One employer. Taxes withheld every paycheck. Straightforward. You bought the $39 software version. Filed March 4th. Refund was $820. What you don't know is that you are statistically more likely to be audited than someone making $500,000. Read that again. You, at $35,000, more likely to face an audit than a person making $500,000 a year. This is not an accident. The IRS audits returns it can resolve cheaply. Your return is simple. Your documentation is limited. If the IRS finds something, you don't have a lawyer to call. You have a shoebox and a copy of your W-2. The wealthy have lawyers, accountants, response teams that make auditing them cost more than the potential recovery. The IRS is a government agency with a budget. It makes the same calculation every other institution makes. Where's the lowest effort return? That calculation lands on you. The audit letter arrives in October. The IRS wants documentation for the $1,200 home office deduction you claimed. You work from a desk in your bedroom 3 days a week. You measured the square footage. You did the math. The deduction was legitimate. You spend 6 hours assembling documentation for $1,200, while a private equity manager across town structures a carried interest arrangement sheltering $4 million from ordinary income tax. His CPA files the paperwork in 20 minutes. You send everything certified mail. You wait 9 weeks. The IRS accepts it. No changes, no apology. Just a letter that says the matter is resolved. You lost 6 hours. They lost nothing. That is the transaction. The second rule. At $35,000, the tax code was written for you to follow and for someone else to navigate. Level 3. $75,000. You got the raise. You moved from $54,000 to $75,000 over 3 years. You felt it. Then April came and you felt something else. You owed $1,900. Not a smaller refund. You owed. One W-2. Same job. Standard deduction. You did nothing differently. The number moved and the math underneath it shifted in a direction nobody warned you about. You call a friend who files returns for a living. He explains. Your effective rate went up. And more importantly, you are losing access to things. The student loan interest deduction. The IRA contribution deduction. These phase out as income rises. The benefits designed for people who need them disappear quietly as you become someone the code considers capable of surviving without them. You didn't get richer. You got moved into a bracket where the rules changed. You adjust your withholding. You open a traditional IRA and reduce taxable income by $6,500. You discover HSAs, a health savings account that lets you contribute pre-tax, grow tax-free, and withdraw tax-free for medical expenses. Triple tax advantage. Nobody told you about this at $35,000. Nobody mentioned it at $54,000. You found it by accident at $75,000 while trying to stop owing money in April. The tools existed the entire time. You just weren't in the right conversation to hear about them.
Here is what nobody tells you at this level. The standard deduction is $14,600 for a single filer. It was designed to simplify filing for people whose deductions don't exceed that number. At $75,000 with rent and no mortgage, you almost certainly take it. The wealthy almost never do. They itemize. Mortgage interest, charitable contributions, business expenses, state and local taxes. The standard deduction is a consolation prize dressed as a convenience. The third rule: at $75,000, you earn enough to owe more and not yet enough to reduce it. Level 4, $150,000. A CPA now, her name is Michelle. You pay $600 for the return. The first time you see the bill, you feel it. Then she shows you what she found. $4,200 in deductions you missed last year. $1,800 in credits you left on the table. The $600 fee recovered $6,000. You renew immediately. The alternative minimum tax, a shadow system running parallel to the regular one. It was designed in 1969 to ensure the wealthy couldn't reduce their effective rate to zero. It was not indexed to inflation for decades. It crept down the income ladder until it started reaching people like you. Professionals, dual income households, people with stock options. You might owe AMT, you might not. Michelle checks. This year you don't. Next year, after you exercise the options from the job you started in March, you will. You didn't know you had a stock option problem until you had a stock option problem. The optimization begins. 401k maximized, $23,000. HSA maximized, $4,150. Backdoor Roth IRA because your income now exceeds the direct contribution limit. Donor-advised fund for the giving you've been doing haphazardly. Michelle shows you that bunching 2 years of donations into a single year lets you itemize instead of taking the standard deduction. You claim $22,000 in deductions instead of $14,600. Same giving, different timing. $2,400 in savings. The tax code rewards people who understand it. Understanding it costs money. You now have enough money to pay for the understanding, which means you now have enough money to reduce what you owe. The fourth rule: at $150,000, the tax code stops being a form you fill out and starts being a system you learn to move through. Level 5, $400,000. The meeting with Michelle is different now, longer. She brings a second document, a tax projection for next year. Not what you owe this year. What you can do between now and December 31st to change what you'll owe next year. You own a side business. The qualified business income deduction lets you deduct up to 20% of that income before calculating your tax. The business made $120,000. You deduct $24,000. On paper, the money still exists. You moved it to a different column. Real estate depreciation, you own 2 rental properties. Every year, the IRS allows you to deduct a portion of the building's value as if it's deteriorating. The buildings are not deteriorating. They are appreciating. But on your return, they generate paper losses that offset real income. Last year, that offset was $31,000. You pay tax on what remains after all of this. The person making $35,000 pays tax on every dollar earned minus the standard deduction. You pay tax on every dollar earned minus the 401k, minus the HSA, minus the QBI deduction, minus depreciation, minus the donor-advised fund, minus business expenses. You earn 11 times what they earn. Your effective tax rate is 4 percentage points lower. The fifth rule: At $400,000, you are no longer paying taxes on income. You are paying taxes on whatever income you and your CPA agree to show. Level 6. $1 million. Capital gains. This is the line that separates the working wealthy from the investment wealthy. At $1 million in ordinary income, your marginal rate is 37%. At $1 million in long-term capital gains, your rate is 20%. The teacher making $68,000 a year pays a higher marginal rate than the portfolio generating $1 million in gains. This was not an oversight. This was a decision. The capital gains preference exists because legislators determined that investment income deserved different treatment than labor income. At this level, it is not a philosophical question. It is a line item. You are not earning salary primarily anymore. The money you have generates money. That new money is taxed at 20%. The money you make by showing up is taxed at 37%. The IRS draws a line between what your body produces and what your capital produces. Your capital wins. A team now. Tax attorney. CPA, estate planner, they meet quarterly. They look at your situation in August, October, December. They harvest losses to offset gains. They time realizations across tax years. They gift appreciated stock directly to the donor-advised fund, which means you never pay capital gains on the appreciation, and you deduct the full market value. The IRS has never contacted you. Not once. There is no audit letter, no certified mail. Your team would respond to one with documentation that takes longer to read than it does to resolve. The IRS knows this too. The sixth rule. At $1 million, the tax code gives money a lower rate than it gives people.
Level 7. $10 million. The trust documents run 140 pages. You didn't write them. An attorney named Whitfield wrote them. He charged $28,000. The trust will save your family more than $3 million in estate taxes across 2 generations. This is legal. Every structure is legal. The tax code was written by people. The people who wrote it were sometimes the same people who benefit from it. This is not conspiracy. It is a process that has been visible for decades and continues because the people who benefit from it are the people who fund the campaigns of the people who write it. Grantor Retained Annuity Trust, Spousal Lifetime Access Trust, Irrevocable Life Insurance Trust. Each has a specific function. Each exists in the tax code because someone lobbied for its existence. You are not exploiting a loophole. You are walking through a door that was built, labeled, and held open for you. A private foundation. You contribute $4 million, fully deductible. The foundation grants money to causes you support and some you are professionally connected to. It pays your daughter a salary to administer it. Its investments grow tax-free. The money you put in never gets taxed again in your lifetime. The word philanthropist appears in a publication about you. The word is accurate. It is also incomplete. The 7th rule. At $10 million, taxes are not paid. They are negotiated in advance. Level 8. $100 million. The audit rate for Americans making over $10 million dropped 75% between 2012 and 2022 as the IRS budget was cut. The audit rate for people claiming the Earned Income Tax Credit held steady. You don't think about audits. You haven't thought about them in years. Whitfield's team handles compliance. Every position has a legal opinion attached before it's executed. The tax code is not something that happens to you at this level. It is something your people manage on your behalf. A yacht. It is categorized partly as a business asset. A meeting was held on it. This qualifies it. The logic sounds like something someone says when they're trying not to laugh. The IRS accepts it because the documentation supports it, and challenging it would cost more than the deduction is worth. Your effective tax rate is 8.2%. A nurse in Ohio pays 22%. Nobody broke a law. The law accommodates both of these outcomes simultaneously. It was written in rooms that nurses don't get invited into. Here is what nobody tells you about this level. The people at the top are not cheating. Cheating is illegal and sloppy. What they are doing is legal and precise. The system they are navigating was built to be navigated by people with the resources to understand it. The code doesn't say you need to be able to afford to read it. It just says, follow it. The eighth rule. At $100 million, the tax code is not a burden you carry. It is architecture someone else designed to your specifications. Somewhere right now, someone is sitting in a library on a Tuesday in February. A retired accountant named Gerald is explaining the earned income tax credit to them. They are nodding. They understand about 40% of it. The refund is $1,240. They will wait 21 days. The money will go to back rent and a car repair, and $200 they promise themselves they'll put somewhere smart. They don't know that the same government sending them $1,240 allows a trust structure 2 miles away to shelter $3 million across 2 generations. They don't know that the software they're paying $89 for was built by companies that lobbied against the free version. They don't know that their $17,400 is more completely taxed than income that is 5,000 times larger. They sign at the bottom. They thank Gerald. They walk out into the February cold with a printout and the knowledge that in 21 days, something will arrive. They think the tax code is a form they fill out once a year. It isn't. It is a system that runs continuously, built and rebuilt over decades in rooms they were never in, by people whose returns look nothing like theirs. The same system that charges you $35 for being broke. The same system that waives the fee before you ask when the number next to your name reaches the right threshold. The tax code doesn't change at every level. The tax code reveals what it always was.